far as selecting a business entity, this is always question number one that I get when somebody comes to meet with us. And although I do have it set up as a presentation on the various types of entities, what I like to do, though, is kind of talk about it somewhat holistically in the sense of looking at all the different options and narrowing it down to which one is most appropriate for the way you're going to operate your business. The most common thing you'll see is the sole proprietorship, the partnership, the C corporation, and the S corporation. Everyone talks about the LLC and the LLP, and maybe I should survey because we have a couple of attorneys in the room, but generally we find that probably in 90% of the cases of the businesses that come to us, the attorneys are setting them up as LLCs or an LLP, predominantly LLCs. Does anybody want to kind of venture a guess as to why? Do I want to throw it to an attorney, or should I go ahead and answer the question? Does anybody have an idea as to why?
I was just going to say it's probably gets the attorney more income.
Okay.
I don't know how to put it.
Okay, well, I'm glad you said that. I did. And I think there are probably other people who thought that. But in any case, now, the issue with the LLC and the LLP, and that LL stands for limited liability, so it generally makes a lot of sense to set yourself up as one of these entities. But the advantage to it, and the reason that it can be somewhat generic, that almost anyone can set up as the LLC or the LLP, is because from there, you can decide how you want to be taxed so you can fit into any of the other categories. So you can be an LLC operating as a sole proprietorship, you can be an LLC operating as a partnership, you can be an LLC operating as a corporation, and you can be an LLC operating as an S corporation. So when somebody asks you what type of an entity you are, and so often I get at least as far as how you're taxed, also often I get, we're an LLC. Well, an LLC doesn't tell me which one of these categories you actually fall into as far as how you're filing your tax return. So to a certain extent, you've got to make a distinction between the legal side of things, which is where the LLC comes into play in order to limit your liability again, versus the tax side, which goes through and makes you fit into one of these categories. Okay, does that make sense to everybody? So the sole proprietorship. That's the one a lot of people think of where it's a part of your personal tax return. It's a Schedule C. It's the simplest to set up because about the only thing you need to do is register with the Secretary of State's office to get a trade name, and you're pretty much in business. The issue with it, and this is where again we'll keep coming back to that idea of the LLC and the limited liability company, is that as a pure sole proprietorship, not operating as an LLC, you've got unlimited personal liability. So again, the advantage is you set up as a limited liability company, it limits your liability exposure, but you can then operate as a sole proprietorship and file a tax return such that it is part of your personal return, meaning it's going to flow through onto your personal tax return. It's actually part of your personal return. The other entity that comes into play, again, because it's simple to set up, is the partnership. The idea of the partnership is basically it's a sole proprietorship, but now we've got 2 or more people involved in the business. So it's kind of the next level up. And again, you can operate as a limited liability partnership or actually an LLC, still being taxed as a partnership. Now with both the partnership and the sole proprietorship type entity, all of the income flows through to you personally. And because it flows through to you personally, it's considered self-employment income. So you're going to be paying taxes on your income from that, plus you have to pay self-employment taxes. And that becomes an issue just because as a self-employed individual, as opposed to being an employee, you're kind of dinged for both parts of the Social Security tax. So as an employee, you've probably been accustomed to the idea that you're having to pay in 7.65% of your taxes to cover Social Security and Medicare. As a self-employed, and then your employer pays in the other 7.65%, which you may or may not have been aware of. Well, when you're self-employed, you're picking up both halves of that. So you're paying in not only your 7.65% as the theoretical employee of your own business, but you're also having to pay in an additional 7.65% because you're the owner, the employer of the business. Does that make sense to everyone? So you're looking at roughly an additional 15% in self-employment taxes on whatever you earn through the business. And when I talk about earnings from the business, I'm generally going to be referring to the net income. In other words, whatever your total income was minus all of your business expenses to come down to the net income in the business, and that's what you'll pay your self-employment tax on. Now for income tax purposes though, you also get to deduct your personal exemptions, your itemized deductions before you come down to taxable income. So there are some other deductions that you get before you came down to what your actual income tax was. But I'm emphasizing this because when I talk to people about operating as a sole proprietorship or a partnership, you really need to keep in mind that, first of all, you've got that 15% of the self-employment tax. You've then got on top of that probably another somewhere between 15 and 25% of income taxes on that, and then you've got income taxes at the federal level, and then roughly maybe another 5% for state income taxes. So when you total it all up, it's not uncommon for me to talk to business owners saying, you need to set aside somewhere between 35% and 45% just to cover all the different taxes. And I'm not trying to terrify you from going ahead and setting up your business, but I just want to make sure that you're aware of all the different pieces, and in particular the self-employment tax. And we'll talk about that a little bit more when we get to the S corporation. Again, one of the disadvantages to the partnership is the unlimited personal liability, which is fairly easy to avoid by setting up as the LLC. The C corporation. The C corporation differs, and we see very few of these locally. Small businesses don't tend to operate as C corporations. In any case, the idea of the C corporation, probably the most common purpose for it is that you're looking to have multiple investors in the business. You can have lots of shareholders in the company. Obviously, with the sole proprietorship, you only can have one. Partnerships can have unlimited, but they tend to get unwieldy, so you don't usually see lots of owners in a partnership. Depending on the type of partnership, there are some, certainly publicly traded partnerships that have thousands of partners involved. But the C corporation tends to be what I think of as more or less the publicly traded corporations. It does not mean that there aren't some C corporations that certainly that we handle, but it's not all that common. The big distinction with the C corporation is now we are talking about a corporation, so you've got the limited liability that goes with that. The other issue with a C corporation, and just to explain the reference to the C in that is that that's the subchapter of the Internal Revenue Code. So that's why people talk about C corporations versus S corporations. In any case, with the C corporation, it pays its own tax at the corporate level. We've talked about the self-employed, the sole proprietorship, and the partnership. Well, in those two cases, the income flows through onto your personal return and you pay the tax. With a C corporation, the corporation pays the tax, and it would pay you wages. So you would actually get a W-2 coming out of your company. Does that make sense? So you can kind of see the distinction between a C corporation where it pays its own entity-level tax. And when I think it mentions it actually in the last slide, where it talks about the idea that as a shareholder you may receive dividends that come out of the company. In some cases, if you rent property to the corporation, there might be rent coming out, those kinds of things. And the other thing about a C corporation is you'll hear a lot of people talk about the double taxation, because now you're in a situation where the corporation is paying a tax, it then distributes its earnings out to you in the form of a dividend, and you pay taxes yet again. So it kind of depends on what tax rate the corporation is and what tax rate you are in as to how high of an overall tax you're going to be impacted by. S corporations, again, it provides the same protection. It does set up a situation where you will be considered an employee of the corporation. And in a lot of cases, it's nice to be treated as an employee in the sense that I have a lot of clients that think in terms of being an employee. So that they're in a situation where they're accustomed to taking out payroll, they're accustomed to having their taxes withheld, as opposed to the self-employed individual. And when I talk about self-employed, again, I'm referring to the partnerships also. But in those cases, in order to pay in your taxes, you need to do it via quarterly estimates. A lot of people don't like quarterly estimates. It's not a habit they're into. They forget when they're due. They don't understand how to calculate them. All those kinds of issues come into play. So in a lot of cases, people prefer to operate as an S corporation. Now, when I go through this discussion with clients, when they first come in the door, we kind of go through a little bit of a flow chart in determining which entity they should be. And one of the issues that comes into play with things like S corporations and partnerships is that they do file a separate tax return. So it means there is a little bit higher level of, at least from my perspective, a little bit higher level of sophistication as far as what needs to be done. It also means there's a little bit higher cost associated with it, with both the partnership, the S corp, I should say all three, S corporations and C corporations. There is at least a minimum tax due to the state of Vermont. So there's that additional cost that flows through to you to set up a separate entity such as an S corporation or a partnership. So you need to keep that in mind. There's also additional accounting and tax preparation fees. So there are some costs certainly associated with it. And the other big item that comes into play is for a business with only a single employee in it, such as yourselves, and you aren't going to have other employees, you now have to deal with all the issues associated with payroll. And again, a lot of people don't like those issues. Now you've got to make sure that you've got a payroll system, you've got the withholdings in place, you have the remittance process in place, and at the end of the year, the W-2 process. So there's a little bit more sophistication there. There are third parties that can assist you with it, but it does add that complexity that you need to be aware of. So the advantages to the S corporation is, again, it's a separate entity. It does allow for multiple owners, not as many as a C corporation, but it does allow for multiple owners. And it is a flow-through entity, meaning that whatever net income that business generates will flow through and will need to be reported on your personal return. So again, to come back to the LLC, LLP, both are set up with the idea of limited liability. We see more limited liability companies, and again, I guess because we do have attorneys, I can throw it out to them, but we tend to see more of the limited liability companies because my understanding is they tend to fall under state law dealing with corporations as opposed to partnerships. Corporate law is a little bit more ferreted out, I guess, a little easier to follow. So again, we see a lot more of the LLCs than we do, the LLPs. Is that fair enough to say that that's one of the factors that comes into play?
Sure, I would just add to that for the limited liability company especially, there is just a recently revised act that really fleshes out how you run your business, or at least in terms of legal management. Whereas the limited liability partnership doesn't have quite as much structure, so we tend to use LLCs a little bit more frequently.
Okay, so it looks like everybody's in agreement on that one. So that is what we see predominantly, the LLC versus the LLP. And as was pointed out, there is the new legislation that came out that tightens it up even more so as far as operating as an LLC. So now I was going to wait till the end for questions, but I think now is actually kind of a good break point if people do have questions.
I was just going to ask, so that why was someone not choosing LLC as opposed to a sole proprietorship? Is it because of the additional regulations and a little bit extra work setting it up, or are there any extra costs to an LLC?
There's nominal additional costs associated with it. It's registered with the state. There's a slight, what is it now? Anyway, they just increased it again?
125.
125 now? Okay, so it's relatively inexpensive to get set up. I always tell people it's probably the cheapest insurance premium you'll ever pay. So it does make sense to set up as an LLC. So your point's a good one in the sense that anybody that would come in to talk to us, we would say, if you want to operate as a sole proprietorship, first you want to set up as an LLC operating as a sole proprietorship. The other comment that I'll make along those lines, and I'm hoping I've answered all of your questions there, but the other comment I make along those lines is we always recommend that someone setting up a new business also go out and get a separate business checking account. The whole advantage to operating as an LLC is to limit your liability. If you start commingling your personal activity with the business activity, it starts to look like they're one and the same, and it kind of takes away from that limited liability that you could have otherwise. The other thing we always recommend is you can get a business credit card, or at least a credit card that you use entirely for business is maybe the better way to phrase that. Because a lot of times the credit card companies won't give you a true business credit card, but as long as you've got a credit card that you're using for business, it just helps you with the accounting piece. It will be a nightmare for those of you that want to use one credit card for both business and personal purposes. Because as you can imagine, all the different activity goes through there and trying to track it and break it down between the two. Okay, so that's one thing I would tell you. Yes, sir.
So I'm not sure if this is an accounting question or waiting until our legal seminar next month. But how does one go about setting up with the Secretary of State, your LLC? Is there like part A is LLC and then part B is sole proprietorship, if that's the way you want to go? Or?
Actually, from a tax perspective, you'll be a sole proprietorship. So there's nothing you need to do other than when you file your personal tax return. From the LLC perspective, you do go to the Secretary of State website. I'll give a little bit of a pitch for the attorneys here. I usually suggest that you work with an attorney, and it's not, I do not consider it a super expensive process for the attorneys to assist you in setting up your entity, and it now allows you to establish a relationship with an attorney, which you may want, hopefully not too much, sorry gang, but that you at least have somebody that you've worked with before. But then, to be totally honest, you can do it yourself on the website.
So you don't have to declare yourself as a sole proprietorship. The first step is LLC,
Yes.
and then you don't have to, then I guess when you file your income tax, then you say, okay, I'm not gonna check the sole proprietorship.
Basically, yes. You can also, at the same time, when you set up the business, then you can go through the process of saying, well, I've decided I want to operate as an S corporation, and there's an election that you would make that you've decided to operate as an S corporation. So you effectively have to go away from operating as a sole proprietorship.
Yeah, no, I'm talking about a sole proprietorship,
Yep,
not an S corp.
right. Yes, sir.
So I'm a sole proprietor, thinking about becoming a single member LLC. I pay a lot of money in liability insurance.
Yes.
I'm just trying to figure out what the difference in protection between being a single member LLC as opposed to what I'm doing now. Because I heard, like you said, if you don't maintain your sole proprietorship according to all the guidelines in the LLC, like keeping everything separate from personal, then you might as well not even have an LLC because it doesn't protect you, that's it.
That's probably best answered next month in the
By the
legal one.
lawyers.
You've got the
So
right
you can-
idea, though,
but
and what I
yes.
would tell you is because of the nominal cost to operate as an LLC, it almost always, there's very few exceptions to where it wouldn't make sense to still be an LLC, but operating as a sole proprietorship. Even if you're not perfect as far as all of the keeping your books separate and everything, I would still steer you there just because it's not much of an additional cost. I think the other part of it too, which is kind of nice, is whatever you name your business and you put the LLC at the end of it, nobody knows how big you are. I mean, if you want to put one of those flowery websites up there and you've got, pictures as if there's 200 people in your company, it's difficult for third parties to know how big you are when you operate as an LLC because LLCs have been around for, I don't know if it's fair to say centuries, but certainly decades in Europe, so it's not an uncommon title, I think.
I was told that if I take my name and I stick it on either of my trucks, then my insurance won't cover me if I get into an accident because it's now being used for commercial purposes.
You do have to be careful with your insurances as far as,
I got like a million different insurances and they all clash with each other.
I don't know when that gets covered. Does that get covered in one
I
of
don't
the
know whether
presentations,
the-
Louise? It's actually a really good question to ask about the insurances.
Yeah, I don't think we have anything on insurance,
It's a nightmare.
just the legal.
It is
Workers'
a-
comp, I mean,
Yeah.
there's more than you've ever thought about.
Yes, and every time you turn around and you do something in your business, you almost have to call your insurance guy to find out whether you're still covered or not. So
Yeah.
you bring up a great point. I won't say I have the perfect answer for you, but I still would circle back to that idea that, again, probably in 99% of the cases, if not 99.9% of the cases, as a sole proprietorship, I would steer you toward an LLC. Okay, yes.
Is a sub S corp and an S corp the same thing?
Yes.
Yes.
I don't know why you see both terms. You just see both terms thrown around. I'm not
The
sure,
old,
Jim.
the old term used to be subchapter
Yeah,
S,
you're on
or
subchapter S.
that's the way they used to be called, and then they deleted the sub S.
Okay.
One question here, when you do set up your LLC, I'm assuming that at the same time, the state gives you, I think it's called the EIN.
Okay, you've got a good question, and I'm glad you asked it, because when you asked the question before, it made me think of it. What happens with the LLC is if you're a sole proprietorship and you don't have any employees, you technically don't need to have what they call an employer identification number. That's what the acronym EIN stands for. On the flip side, what you'll find is that most of the banks, when you go into them and you tell them that you're opening up a business account and you're telling them the name of your business and it's got LLC at the end of it, almost all the banks will ask you for your EIN. It is so common now, and again, I don't know if either of you remember, but a few years back, the form that you apply for your EIN, which is with the IRS, and it's a form SS4, and again, you can do that online, and that takes minutes to get your EIN number, but now they've added a box on it where you basically get to indicate that you're only looking for the EIN because you need it for banking purposes. Whereas that didn't used to be an option on, not that I recall anyway, it didn't used to be an option, so I'm not sure, I don't know if anybody has noticed when it came, all of a sudden it was
Yeah.
there. I don't remember when it all of a sudden came out, but it was there.
What's the
But that's
form?
what it's to address.
What
It's
is
an
the form?
SS4.
SS4.
That's so they won't be looking for payroll tax filings.
Yes, yes, and you do have to be careful when you file the SS4. It's another one of those things where it's usually good to go through and talk to either your accountant or your attorney, but to make sure, you have to be careful that you don't X the wrong box. If you X the box that says you have employees, they're gonna start looking for tax dollars that you've withheld through payroll. So you're gonna have that issue. If you X the box that you're a C corporation instead of a sole proprietorship. So there's kind of this litany of issues that you can run into if you don't do it properly. At the same time, I don't wanna make it sound like it's super complicated form. There's not a lot to it, but there are a few twists to it that you have to be careful of. Okay. Yes?
Just a comment on that, I operated down at EIN for a number of years, and then you get to a certain point where, because of your business, they want a social security number or an EIN number, and I decided to get an EIN number because I didn't want a social security number floating around in places that could potentially be a security risk. So,
Yep, okay. And you do have to be careful, I agree, you don't want to give out your social security number willy-nilly. I didn't know if one of you guys were going to chime in there. But technically, you will be requested that you submit a W-9 that indicates what your social security number is if you're operating as a sole proprietorship. So it brings up an issue that I know there was a couple questions where people talked about being independent contractors. And what happens is, as an independent contractor, you're going to find that third parties that engage you want to make sure that they've got your information so they can send you a 1099 that indicates how much they paid you, because they're required to submit that information to the IRS. So it basically matches to your social security number, so they make sure you report it. So as an individual operating as a sole proprietorship, you're supposed to give them your social security number, not your EIN. So that's where you'll get that question, and it comes out on Form W-9, but that only applies if you're not incorporated. If you're incorporated, you do want to give them the EIN.
So if you're an LLC or sole, single member LLC, does that separate you from just being a 1099 worker?
It does not. It does not, and it, again, great question, because it's the big debate now going on in a lot of states, but in particular, it's big in Vermont, because there's an attempt to basically, well, they're defining it most favorably to the state of Vermont in the sense that they want to treat every one of you that's an independent contractor as if you were an employee of the companies that you're doing work for. And what it does is it allows them to collect more unemployment. So what happens is, if, for example, and this is probably somewhat of a weak example, but if, for example, you were spending 20% of your time working for one business, and you are a single member LLC operating as a sole proprietorship, the state is trying to construe it so that you're an employee of that. And I don't want to get political on it, I just know that we've been dealing with the issue quite a bit with clients where we have businesses that it's pretty obvious the individual is not an employee, and they're trying to interpret it. And like I said, the way the state statutes are written, it's very loose and liberal, so it makes it easier for them to define it that way. And it has been a hot button for a lot of small businesses, construction in particular. Construction is probably one of the worst, and it has caused, at least in the construction industry, for a lot of businesses just go to a corporate structure. They'll go right to the S corporation, so they don't have to deal with the whole independent contractor issue or not. Because the issue that comes about is, it's the company that's engaging you that has the exposure. So you two guys are talking about doing some construction work, you're engaged by a larger construction company, they're going to be a little bit nervous about you guys operating as a partnership, for example, just because they need to make sure that you're doing all your taxes properly, and that the state is not going to come in and assess them, in essence, unemployment on you guys because they didn't treat you as an employee the way they should have. Okay. All right, so why don't we keep moving on this, and I'm sure we'll get some more questions, and then I'll let you guys answer the question. The next round of questions is on you guys. Okay, so the cash basis accounting method. When you first file your tax return as a business, you're going to find that there's a question that says, how are you doing your books? How are you filing your tax return? Are you filing it on the cash basis of accounting, or are you filing it on the accrual basis of accounting? And there is certainly some overlap on your internal books here, obviously, but it's more of a tax issue that I'm trying to emphasize here right now. From a other perspective, what you'll find is that for your tax return purposes, you may file cash basis, but for your own internal books, you may file accrual basis, or keep your books on an accrual basis. And I'll spend a little bit of time going over that because it is confusing to follow. So this is one of those areas that I always feel it's necessary to go through it, but it's always tough to go through it, to be honest with you. So the idea of the cash basis accounting method, though, is that basically it's recorded just the way cash would be. If you receive cash for services that you performed, it's income at that point. When you pay a bill for an expense that you've incurred, it's deducted at that point. So it's purely the cash in, cash out as far as how it's reported. All right? There are some exceptions to businesses that have the flexibility of using the cash basis accounting method. The predominant one there is retail, and it seems to me I had one or two that's mentioned retail, that you pretty much have to be accrual if you're on a retail basis just because of the inventory issue. It's very difficult. It's very uncommon to have any inventory without an associated payable for when you purchase the inventory. So you're going to find that that's why you kind of get forced into utilizing the accrual method of accounting if you've got inventory. Almost anyone else can use the cash basis. And again, I would say you may use it for tax purposes, but I would steer you toward accrual for your own internal books. So now that everybody's thoroughly confused, we've already got one question.
Sorry. If you buy a vehicle,
Okay. So with a fixed asset question, but anyway, okay,
well,
go
no,
ahead.
if you buy a vehicle, can you, do you have to pay cash for that vehicle in order to count it as paid for? I mean, it's probably a stupid
No,
question.
it's a great question, because that's why I said it's a fixed asset question, because fixed assets are kind of the exception to this rule, and the idea that you might go out and buy a piece of equipment. Let's say it cost you $10,000. You might finance $8,000 of it. So in theory, you would think of that as accrual because it's a liability you haven't paid yet. But because the type of liability it is, and the fact that it's an asset, a fixed asset, you actually are allowed to start depreciating the full $10,000 immediately. And when we get it toward the end of this, when we talk about the first year depreciation deduction, you actually can deduct the full cost of it in year one, even though you've only paid $2,000 down out of the full $10,000. So it's a great question.
That was my second part of the question. That came with 3 questions, that's one.
Okay, so let's spread them out so you don't have to leave too early. Okay. Okay, so cash basis, just a quick example. It's the idea that you've got an individual with a painting business, does a job on April 15th, but doesn't collect payment until May 1st. You don't technically record the income until May. The example also holds true if we're talking about at the end of the year. So if you do work on December 15th, but you don't actually receive the payment until January, it's not income until January, so you don't pay taxes on it until a full year later. Okay, that was a hint as far as tax planning. Okay. So on the expense side, you pay the annual rent of $12,000 in one lump sum. Admittedly, this is an extreme example, but I wanted to try to make the point. So you've paid all $12,000 in January. Theoretically, anyway, you would deduct all $12,000 in January, and all the other months would show a 0 for rent. Again, that whole cash basis concept. The accrual basis accounting is more based along the idea of when the income is earned or the expense is generated.
Can
Okay.
I, one quick clarification about the cash base. So you said when the check is received, not when the check is cashed or deposited,
Correct.
right?
Okay, so the idea again is it's revenue when you've completed whatever that project was and you've billed for it. Now it's revenue. All right, so you're going to recognize it as income. Revenue, income, kind of the same idea. Okay? As far as the expenses are concerned, it's when the expense is incurred. So you've gone out and you've purchased something at Staples or whatever, and you get the bill a month later. Well, it was incurred in the prior month, so you do record it in the prior month. And what I like to emphasize as far as the distinction, and the reason I tell people that probably you should be using the accrual or maybe a modified accrual, if you want to call it that, for your own personal purposes, is because it helps you track, especially when you're trying to do year-to-year comparisons, it helps you track how your business is really doing in the month of June this year versus June next year, with the idea that if you did the work in June this year, you billed it that month, it should be considered June income. That was the month you were busy doing work. The problem is, for example, again, if you did the work in June and it doesn't get paid until August, and you're on the cash basis, you record it as income in August, and in August you may not have done any work, or you may not have completed any work, or you may not have billed anybody for any work then. So it's a distortion that it makes it look like it's an August product as opposed to a June product. Does that make sense to everybody? That's where I do get a little bit hung up on the idea that I think it's important to use the accrual method for most businesses for their internal records. It helps you track how you're actually doing month to month throughout the year. Yes?
Can you switch?
Oh, God.
That's an important question, because when you start up, you might want to, in my opinion.
And it is a good question. Usually, are you talking about just for your own internal books, or are you talking about for tax return purposes? For your internal books, you can flip-flop back and forth.
Okay.
And in fact,
No, for tax.
for tax purposes, it's more difficult. The IRS likes the accrual method because they feel it represents income more accurately, and I think it ties into the fact that it's a little more difficult to manipulate cash. Did I say that right? Manipulate the accrual method.
Manipulate the accrual, it's
Right.
harder to manipulate if you're on accrual for tax. Cash, of course, you can just defer, not go to your mailbox for 3 years.
There we go.
Or, defer making a payment or accelerate making a payment. You can manipulate your taxable income more if you're on the cash method. So that's why they like the accrual. But switching methods back and forth for tax is not easy. You have to, file forms, and they may not accept it and all that kind of stuff. So you want to upfront, pick a method. And usually for small businesses, the best method to pick, at least initially, is the cash method.
Yeah, it is a case where you'll start with cash, and as we were saying, it's not terribly brutal to change to the accrual method, but once you're there, it's pretty brutal to go back the other way.
Okay, so
Yeah.
you theoretically,
So you
you
can
can start
migrate
as
there.
cash, and then in the startup year, because you've got a lot of expenses, maybe a lot of income from a different job, and then you can switch to accrual and make everybody happy forever.
You could. You may not want to, though. For tax purposes, you still may not want to.
Okay.
But I would steer you toward keeping your own internal books on the accrual method. Does that make sense to you? So you end up with an, sorry?
Would it be more complicated to have two sets of books?
No, well,
It's
yes
actually
and
not
no.
more complicated. If you are using a tax or a software program, a lot of times, if you're doing it correctly in the system to begin with, you can just run the reports on either one and it will do the change for you. So
That was the big if, though. If you've got your
Yeah.
books
Right.
accurate,
If you have your books
you can flip back
accurate,
and forth.
the program will do it.
Squash like a bug, so.
Well, I mean, just being self-employed does have a higher tendency to get audited because so many people walk a fine line and maybe fall off the cliff. That does tend to bring on the IRS more frequently, but it isn't like an automatic.
I'm sorry to slow you down, but I really do have to ask you about startup costs, because I did talk with an accountant, and that person told me that startup cost is a very nebulous definition. Like,
I agree
you
with
know, because I started a franchisee, and she even thought that the education that I got from the franchise group long before we even launched was not startup cost. So I think, I don't know. I mean, I don't know, do you just go to whoever and keep going until you hit the answer you
I'm
like?
trying to think if I've ever seen a list. It seems to me I've seen a list for like franchises, and I'll be honest with you, I thought education was one of the items on that list.
Yeah.
But I
It's
don't know.
Startup is any cost that you incur as part of the business that normally would be deductible, but because you haven't opened your doors, you have to capitalize and wait till you actually open your doors and
But
launch.
open your doors, this business will have its doors open for months before we get revenue. 'Cause
And a lot of people make the argument, even if they don't have revenue, that they're in business because their doors are open.
Yeah.
And they can deduct those costs.
Okay.
The IRS may question it, but that doesn't mean you would lose technically. Okay, if your doors are open, you're open for business, and, you know, you could take a customer today, you're open.
Okay, thank you.
But we rarely see startup costs that are above the $10,000 number. We
Well,
rarely
it depends
see that.
upon the business,
It
but
depends
yeah.
on the business, but I guess what I'm getting at is, most of the other expenses, they start to pay after the business has opened its door, and they become just a normal operating expense at that point.
Yeah.
You know, because there isn't that long window between when they've started to explore it and when they actually opened up for business.
Yeah, that's just different than revenue coming in.
Yeah,
It
yeah.
can be
Yes,
significantly
yeah, yeah.
different.
Yes, it can, and I don't mean to
The
make it sound like there isn't that
exploration
window where you could be open for 6 months without having any revenue.
Yeah.
Okay. Okay, the example, pretty much we've already covered it. They do a job on April 15th, don't get paid till May 1st, the income's in April. The flip side with the rent, you prepay the rent, but you actually pick it up as a deduction of $1,000 each month rather than all $12,000 in January. And this kind of comes back to why I was saying that I like to use the accrual method for at least your internal books, because it really kind of matches the income with the expense, the income with when it was earned, the expense with when it was accrued, that kind of thing.
Yeah, okay, question here for the matches. You know, for the accrual, you expect, you know, your transaction occurred that day. You may not get your real money for a long time.
True.
Then you get a mismatch.
Yes.
Even the money you did not receive during the tax season, you have to pay tax. What do you?
You're right. I get your perspective. My point, though, was you actually earned it when you sent out that invoice back in April or whatever, not in June or July when you actually got paid. So it's a matching concept more of when it was earned, not a matching of when you actually received it. So yeah, maybe I should get rid of that slide. I can see where I can.
Well,
that's a
I
good
mean,
point,
but you're also incurring expenses, and so you're the time when you're earning the revenue and the time when you're taking the expenses are the same time, is matching as well. So, I mean, you're right, it isn't a cash flow concept, it's more of, you know, you're matching income and deductions. But people do go to the accrual method because sometimes they have to pay a lot of expenses on account. They incur a lot of expenses on account that they don't actually pay, and this accelerates your deductions by going on the accrual method. But it may hurt you on the revenue side from a tax.
And you're right, there are a few businesses where it actually is better for them to be on accrual just because they do have more expenses than they do have income. They have very little receivables, for example, that their business is pretty much a cash business, but they still have a fair amount of expenses that they haven't paid for currently. So in that case, it's going to make sense to be in the accrual, and it will actually be to their benefit. Okay, so we've already talked about the organizational startup costs. The home office deductions, I don't want to spend a lot of time on that either, but I do want to highlight that even though you hear people talk about it as being a red flag, I always tell people if you really do have an office, a home office that's separate from the rest of your house, it meets this criteria. You know, the space is used exclusively and regularly as the principal place of business, a place of business dealing with patients, clients, or customers, and in connection with the business if a separate structure is not attached to the dwelling unit. So there are these exceptions, I guess, where as long as you meet that criteria, I tell people, yeah, go ahead and do the home office.
Question. So, we're both going to have an office in our house. Can we write off 2 home offices? I'm just, you know, because he's going to, because we're going to be doing our paperwork from a single, you know, he's going to be doing it from his home, I'm going to do it from mine.
Right. And how are you guys going to be operating? Are you going to be operating as a partnership, or are you going to be operating as an S corporation, or what are you going to do? You know,
I was looking at the LLC SCORE,
Okay.
but we live an hour away from each other,
Yep.
so we couldn't have an office in the same spot. Well, we couldn't and then be in the field, it wouldn't be time sensitive.
Right. The reason I asked the question about how you're doing business is technically, and I hate this rule, but I have to bring it up, is that technically you can have a home office with an S corporation. You
Okay.
cannot. Okay? There's a little wiggle room with interpretation as to how that applies, but the technical rule is that you can't have a home office.
Okay.
Okay, so that would negate that possibility. If you operated as a partnership, which for other reasons that I've already mentioned, as far as you guys in the construction industry, I probably would steer you more toward the S corporation. I don't know, I'm trying to think if I have anybody that's ever done 2 home offices that way with a partnership. You'd have to do it as, I think you'd have to have a side agreement in the partnership agreement that would talk about unreimbursed partner expenses, and then you might be able to have it flow through. Yeah, that's the only place I can think of. It's a good question, though.
I mean, you could have the entity pay you rent, and isn't that the...
Right, and then you'd end up with a, right. IRS doesn't like that one either. You kind of got to
Yeah.
break even on that one, but you could do it. There are a couple options on how you would do it, but if you look at the S corporation, there's kind of a technical requirement that you don't do it that way. Okay.
As a sole proprietor, I have a garage that's detached from my house, so I can use that for my
You
business.
can.
What
You
about
can.
my office that's after my living room?
It has to be exclusive in your living room, so you wouldn't call it living room. For starters, you would make sure it's never a living room.
But I have a fireplace and a couch and all that, it can still all be the office?
If you don't use it for anything other than as your office, then you technically could call it that.
So I gotta take the TV out?
You got it, at least when the IRS shows up at your door. Okay.
Does this impact your property tax?
Yeah, there are issues with if more than 25% of your residence is used for home office type things, you do get dinged as far as how they calculate your property tax adjustment.
Okay.
So it's a long-winded yes, it does affect it, but you have to be above that 25%. We have, I won't say we have a lot of clients, but I can look back and I have clients that were at 24%, you know, that kind of
Yeah, I
thing.
got a funny feeling
So,
that's the right number.
but, you know, to come back to it though, I would say that most businesses that do the home office, for one reason or another, if I see it above 10%, I almost have to ask the question. Because very few people, unless it's a very small, which we do have a few, unless it's a very small apartment or condominium, it usually isn't more than about 10% at most that turns out to be the home office.
What about, you know, you're building, for instance, woodwork products in the basement? That's going to take up a large percentage of your square footage.
Basements are always bad because they don't, as you probably know, they don't measure basements for appraising the property and everything else. So it's a little bit funky in trying to assign a value to the basement, that kind of thing. But yes, I have certainly seen a higher percentage when a full basement is used that way.
Okay. Thanks.
Okay, so that was our quick discussion of home office. Company mileage. On this one, what I was telling you before is there's a couple different options as to how the company vehicle will be handled. One of which is the company can own it. The other of which is you have the company reimburse you. So if you've got a sole proprietorship or you've got your partnership or your S corporation and you own the vehicle separately and it's predominantly personal use, you basically charge it back to the business for your business miles. So if you drive 5,000 business miles a year, you would in essence bill yourself for that 5,000 times the current rate, which this one's the 2014, it's 57.5 cents this year. Okay. My experience has been that the IRS does accept that methodology and that approach. And doing so, you don't need to track all of your related expenses. You don't need to monitor what your gas was. You don't need to monitor what your insurance, your repairs, all those kinds of expenses. So it is the simpler method to use it.
Can you round it up to 58?
And that's the for profit. Isn't there a different rate?
Oh, there's different ones for charitable and there's another one for medical. So there are different rates for those, but that's kind of unrelated to this. So yes.
if you do the reimbursement method, do you also then still have to track your personal miles on that car?
You don't own that car. That's kind of
so
the
it's a personal
advantage
car
to this
that
one.
you're...
Yes, you have it. On the other hand, if the company owns the car, you now have to track all of your mileage and essentially all of your expenses. So we generally tell people there is pretty limited benefit, in part because the depreciation rules change if you tend to use a company car for less than 50% business. If it's more than 50% business use, and in particular, I shouldn't even say it varies with mileage. But in that case, it might make sense to have the company own your vehicle.
What if it's 100%? I mean, that's the, what if you use
100%
only-
business?
Yes.
So Generally, the only way you end up 100% business is you park your car and leave it there
Yep.
every night. So you drive another car to get to the business?
Yep.
Okay, so you're talking like a business truck or something like that,
Yes.
perhaps?
Yep.
Okay, well, it kind of depends on the type of vehicle, but yes, then it's 100% business, so you can deduct it all. Now, if it could be used for personal use, you still have to be careful with the idea that if it's a car, for example, that you could be using personally that's not assigned to another employee, for example, you still need to monitor it. 100%, basically, again, what I would tell you is the IRS doesn't believe you. You're not leaving that car every night is what they would tell you.
Actually, we leave it during the day and we use it to patrol at night. And it's got lights and, I mean, it's,
Oh, okay.
so, I mean, we don't use it and we keep it in a parking lot
Yeah.
that we pay for.
There are specific rules for vehicles that are accepted from the rule,
Okay.
but generally what you'll see is it's, the one that always comes to mind for me is the customized vans.
Yep.
Again, I think I'm for electricians and that kind of thing, where the back section of the van is all torn out and there's really only one seat and the seat's for the driver. In that case, there is an exception. I don't know as far as lights and that kind of thing on top. I don't know of an exception.
Well, usually those are for things like ambulances that generally aren't used for personal use.
Right, right. So you may just fit
So
in the
depends on how far
category.
that goes, you
Right.
might fit into that category.
Okay.
But if it was a
I mean,
pickup
that's
truck that you could not
specifically-
use otherwise, I'd say it's probably still gonna be a case where you're gonna have to track it. Yeah, I know it sounds crazy.
Yeah,
but-
I don't understand it, because it's literally for, that's all it's used for, is patrolling apartment complexes and things, and in the end, we'll have probably 20 of them, so, I mean, that's the whole business, is using those vehicles, so.
Well, it's only for the owner that you have to monitor the 100%. There are some other exceptions that you can apply for employee groups.
Okay.
Okay, so that may
Are all
come
these
into
rules
play.
written down somewhere?
Yeah,
Somewhere.
not only that, but they ask you the question every year on the tax return. You know,
Okay.
do you have another car available? Do you have a log that monitors all your mileage? They have a whole list of questions that they go
Okay.
through that you're supposed to attest to. Okay, so let's keep going then. Meals and entertainment. I only wanted to mention this one quickly because with regard to meals and entertainment, there's basically two categories. One category being meals and entertainment for customers or clients, in which case it's only 50% deductible. So you want to keep a separate record for all of those. As far as expenses that are associated with company-wide functions, for example, the office holiday party, that's 100% deductible. It's not a big item, but you need to track it separately, and you find that a lot of businesses kind of combine the two, and then we've got to try and pull out those that pertain to business-specific employee-type functions. Yes?
So I might have missed this, but as you were mentioning, meals and entertainment with clients, is there a definition or specific designation of that definition of client? I often would need to meet with and court potential clients significantly before then being hired on to do a major project for them. When is somebody classified as a legitimate client for these purposes?
Okay, good question. You're still entertaining, it still fits in the entertainment category, so you're still going to be 50%, whether they're a client or a prospect.
Okay, so prospective
Yes.
clients are in this.
Yes.
So would the 100% of like a office holiday party or whatever, would that only be under like sole proprietor, partnership, corporation? Like, is it only one of those specific ones that it go under? If you're a sole proprietor and you're the only employee there?
Oh, if you were your employee.
Could you throw yourself a party and then write it off?
Okay. Moving on. No, I like the way you're thinking. It's a good question. No.
Real quick, before I move on from that, what about if you're traveling, like travel meals are 100%, you can write up 100% of that, right?
No, the theory there is if you were home, you'd be buying groceries anyway, which theoretically offset 50% of the cost.
But what if I traveled to a trade show and I was having meals there?
50%. It kind of stinks, and they even try to make you break it out of where if you go to a conference and it's buried in the cost, but I never have to break it out. Yes?
Yeah, another travel-related question. So, as an academic who's then doing overflow work in this consulting category, some of my business would be with making contacts through national and international conferences. Any particular red flags? One once you get into international arenas, and that's part A of the question, and part B is, given that some of the work I do is looking at sustainable development, heritage, so I'm working with like national park entities, things that I've been very conservative in terms of claiming deductions, because I thought, oh, some of this stuff is going to look really suspicious, but it is inherent in the work that I do. So,
What I would tell you, and I think this is what you're getting at, if it's business related, and you can argue that it's business related with a straight face, you want to deduct it even if you're only getting 50% of it. But it still makes sense to do it. It's part of the reason I go through that explanation of the fact that for every dollar that you earn, you're looking at, let's call it the worst case, 40% of it to go out to taxes. From my perspective, it justifies keeping good records so you don't miss any of those expenses that saves you 40 cents on the dollar. In fact, I would tell you that the businesses I've run into that had sloppy records that thought they were being cute probably missed more deductions than they underreported their income. Okay.
On that 50% limitation, is that on your personal expenses or if you take 3 clients out?
It's the total. So it'd be the total for all 3 if you paid for all 3.
Okay.
Yes?
What about travel and fees for professional development? Is that a 50% or is it
No,
100%?
the travel, I hope I didn't say travel. Did I say travel and meals? It's meals and entertainment. Travel is going to be 100% deductible. Hotels are 100% deductible. Flights are 100% deductible. It's only the meals portion of it that wouldn't be 100% deductible.
So if I had to travel to go to a professional development course, everything's 100% except for my meals.
Except for the meals. You got it. You got it. And you're right. I was asking if I said it wrong because I think it's actually even on a tax form, isn't it? It uses the term travel and entertainment.
Yeah,
rather
it
than
does,
meals.
so it can be confusing.
really
Because
confusing.
that's the old term and it hasn't totally, because it used to be meals were 100% deductible, many, many years ago.
How about dues to join the Chamber of Commerce?
Good question, because if there's a portion of it that pertains to political activity, they're supposed to tell you, and then that portion's non-deductible.
Okay.
Yeah, you're sorry you asked now.
No,
I think we have 2 clients that ask us to break it out. Otherwise, I don't even look and I don't ask. Okay, it's just too nominal to be worth the obligation. Okay, so real quickly, as far as tax issues, the last one I had was just the ability to hire your child as an employee. And it's a nice little perk for those of you that have kids that actually, or may not actually do work for you, in the sense that it shifts the income from you to their bracket. And since all of them get an exemption, and for 2015, it's $6,300, so you can theoretically pay your child $6,300, you get the deduction for it, and they wouldn't pay any income taxes. All right, and it's a nice way to shift some money to them. I always talk about it with the idea of it's a nice way to shift money to them to use for college. The only problem you run into that is the colleges then factor their income into their financial aid eligibility. It's like you're damned if you do and damned if you don't nowadays. And I always talk about the fact that nowadays when we talk about tax planning for a client, we have to factor in the question that came up before, the property tax. We have to factor that in. We've got to factor in financial aid. We've got to factor in income taxes. And depending on the age of the individual, we have to factor in whether it's going to be Social Security taxable or not, because it pushes them up into a high enough bracket that now 85% of their Social Security is taxable. So I've got 4 or 5 issues that I've got to look for every time we do tax planning for a client. So.
If you hire a child, you're an employer now, though, right? And you have to be.
Yes, you would have to deal with all the payroll issues.
I got a question for that. Is there any labor law limit? What kind of job you can hire a child? What kind you cannot?
There's an exception for your family members. I have to admit, I couldn't quote it. I don't know exactly. I don't know if there's an attorney in the room that wants to stick their neck out on that one, but I don't know what it is. But for family members, there's an exception. But we always talk about the idea that obviously you don't want to have your 8-year-old supposedly doing your books for you, or working construction, or driving the trucks. I don't think that's going to fly. So you'd want to pay them commensurate with what, at least in theory, they're doing. I'm sure they're doing it, but at least in theory, what they're doing. Okay. So we've kind of talked about that one before. First year depreciation, basically this was that issue, using the example of financing and purchasing a piece of equipment. You can still deduct the full amount of it in year one when you purchase it. There's a couple rules that come into play with it though, one of which being that you can only deduct it if it doesn't cause you to go further into the red. You can't go below zero using this provision. So if your net income from your business is $5,000 and you bought a piece of equipment that costs $7,000, you can only deduct $5,000 currently to get you to a zero. All right. On the other hand, if you had $40,000 of income and you bought a truck worth $7,000 or a vehicle, piece of equipment worth $7,000, you can deduct all $7,000 currently. Right now, the rule is that you can deduct up to $25,000 worth of purchases in the first year. These are equipment type items that otherwise would have to be depreciated. So it's a nice little plus. I will tell you that the last 3 years, it's been $500,000. The assumption is it will bump back up to that. Again, it applies to very few businesses. We probably have a handful that we can take the $500,000 deduction for. The vast majority are $50,000 or lower. But it is a nice perk that you get, so you can buy. We talk about planning this time of year. You can go out and buy some equipment in December and take the deduction in the current year. And I hate getting into this stuff. Okay. So one of the other twists to it is if you're self-employed and you go out and buy a piece of equipment, so for those of you that are thinking of operating as an LLC, sole proprietorship, if you're married, your spouse's earnings count toward that threshold. So you could have a business with a $20,000 loss as long as your spouse has $20,000 or more of income and still push it into the negative. I don't know if that makes sense to people, but it's a nice little thing you need to monitor, that if you've got income from your spouse, you can actually play some games on the equipment that you purchase.
What about income from a different job?
Yeah, that would count too.
Okay, so,
Yep.
okay, I thought it had to be from the business.
No. Well, it has to be a sole proprietorship though.
Yeah.
So you couldn't match an S corporation with other earnings. That doesn't work. It's a two-step testing.
Yeah.
One at the entity level and the next at your personal level.
I'd just like to add one comment on that. You actually have to use the equipment in that year. If you buy it in December, and I don't know, it's a big free walk-in freezer or something, but it's not hooked up, it's not being used, then it's not being used and you can't take the deduction. It needs to be something you're actually using after you purchase it, and
Yes.
then you can do this deduction.
Right. So placed in service. Accounting software, what I would say about that is it's probably a little bit more complicated to make the decision now than it used to be because there are so many software programs that are online. A lot of small businesses are now going to online versions of their accounting packages because you have access 24/7. You don't have to worry about backup. There's a lot of pluses to having it online. And again, there's a lot of vendors that are out there now, far more so than there used to be. Probably still the largest is QuickBooks, because QuickBooks has an online version. There's also FreshBooks, and Xero is another one that you'll hear about fairly frequently. The most common desktop software that we see for small business is definitely QuickBooks. I would say they still control about 90% of the market for the desktop. I don't believe they have quite the same percentage for online, but because they've seen some of these smaller businesses picking at the fringes for the online version, it's caused them to have to substantially improve their product.
I would just say that the online versions of programs that I have seen tend to be more simplified versions, and desktop versions tend to have more options for better tracking, let's say if inventory, if your business has inventory, or if you have several different kinds of employees, the online versions simply have just less ability and less features on them. So you may find that it just doesn't suit your needs to have an online one, and you might have to have something a little more robust.
I do think it's improving, but I would have to agree with Jonathan. If you've got sophisticated functions that you need, you probably need the desktop version. Okay. Do we have one more question?
Can go quickly.
Okay. Oh, and the online versions all just charge on a monthly basis. So that tends to be how they're set up, and it depends on what all you're using it for. I think these are a year-old fees, but they're still not much of a difference.